Hey, Michael, how you doing?
Hey, good morning. How are you, sir?
Good. Hey, Steve.
Hey, Steve, how are you?
I'm fine. How are you guys?
I can't complain.
Good.
Morning, guys. How are you?
Hey,
Morning,
George.
George.
Still here. Just
How's
raising
your
the
head
desk
cold?
up high enough. There we go.
George, what is that thing you have behind you on your right-hand side? The other side. The other right. Yeah. What is that?
That, and you're about to see a new one. This is the growth drive methodology. So if you took a screenshot and zoomed in, so these are the 24 growth driving objectives over here, and the 25th bonus question, time to market. And then going across are the key results.
Oh, okay.
And the one thing I'd point out is predictable profits and cash flow. You'll notice that if we drew a trend line, we build so much strength in the first two dimensions that the trend line here on the number of questions diminishes, because a lot of what we need down here in the third dimension is actually created we create predictable profits and cash flow and predictable sustainable growth. Sorry, I geek out. So I have it up on the wall because I stare at it. It helps me think. So the next one you'll see.
Would you say, does it help you sleep? No.
No. It helps me think. It helps me think. And once in a while, somebody will say, "Hey, you haven't considered blank. It doesn't include blank." And you'll notice there's only one pen mark. It's right there. And that's about sustainability. And, it's sustainability with, a ripe conversation. How does sustainability fit into,
Got it.
growing a business? And is it a growth driving objective? That's a debatable point. But that's the only thing I found that isn't really in here at all. Other than that,
So George, can I ask you two questions?
Sure.
I was working with the program yesterday. I was trying to demonstrate it to someone, and these two questions came up, and I didn't have a good answer for them. So, in Clarity 2, where you go through and you quantify the impact on value that each of those objectives, if improved, would have on business value. Where do you get those numbers from?
Okay.
And they're precise numbers. It's not rounded. It's like 127. So what's the source of those numbers?
That's a great question. So there's a bit of a long answer. So when we calculate the value of a business, we're using a 2 decimal point multiple, right? So
Correct.
we go like 6.01, 2.98. So when we do that, even with a round number, we end up with a more complicated number. We start losing zeros. Cool. Well, now, if the business has a value at the top end of the range of multiples, we're going to discount that based on its strategic capacity. When we discount it, now we're multiplying. Let's just simplify and say, okay, well, we're going to take your value at the top end of the range of multiples, and let's use your strategic capacity as a decimal, right? So 57 becomes 0.57 or 57%. And you can transfer on the rough order of magnitude 57% of the value you've created, right? And that, by the way, in the lab hangs together. That strategic value with strategic capacity to the point where we're about to add it to. So now if I take a number, I take $10 million and I'm multiplying it by 2.98, and now I'm multiplying it by 57, I end up with a very precise number. Now we have a choice. Should we round it or should we leave it precise? And I made the decision to leave it precise. I know that rounding it would make it easier to communicate, but I made the decision to leave it precise. We can debate that as a community, but companies. So what we've done is now we've put a dollar value on company specific risk. We can take that company specific risk, and logically that company specific risk can be allocated across the business, right? And there's zero risk in areas where you are top of the charts, and then there is risk. By the way, if you have areas where you're truly top of the charts, you have lower company specific risk and therefore a lower discount. You know, a lower discount rate. So now we allocate it on a weighted basis across the 24 growth driving objectives. Very cool. We still have a precise number. So does that answer your question, Mike? So it's really allocating company specific risk across the business. And I went into the details so you understand how we end up with, you know, $271.
Okay, I got you.
Now, and that's done on a weighted basis.
When you
Now,
say
when we
weighted,
do
in what way? How do you weight it?
We weight it based on, if you think of, and I'm going to simplify again,
Is it
weight
the
it
score,
based
is
on
it the
the
score for
three
that
different
particular objective? If the score is very low, it
score
gets
of
a
the
higher weight?
objective,
Okay.
and then the impact. So let's take growth capacity. In growth capacity, when we look at growth capacity, considers predictable profits and cash flow
Got
and
it.
predictable sustainable growth. With the weight, though, the market values predictable cash flow, but it really values sustainable growth, right? Predictable, sustainable growth. That's what we want to buy.
Okay.
So when we talk about weighting, I'm not going to open the black box any further, but when we talk about weighting, we favor the second dimension.
Okay, I got you.
Value capacity, totally different. Value capacity, you need all three, but you don't have M&A preparedness if you're like, well, you know, but I don't need audited financials. Yeah, you do. Yeah, you do. They don't do schnooky for growing the business, but they're critically important for selling it. Mr. Duke, you don't have to put up your hand. Jump in. Tell me to shut up. Feel
up.
free. You won't be the first. By the way, guys,
you
too
may
funny.
not
We
want-
all have dark collarless shirts on today. That kind of day.
Doc Tuesday.
You may not want to answer this, but so that answered part of Michael's question. But so are you using something like deal stats to get the multiples to begin with?
Something like, yes.
Okay. And are you using?
And by the way, I have gone and looked, and we just compared I just did an informal comparison of our multiples against against an accounting package. And we're hanging. We're in the zone. They use
Okay.
So go ahead, Steve. Sorry.
Follow-up question. So the graphical presentation you showed us last week of growth rates, is that coming? Do you mind saying where that's coming from, or
Sure,
not?
I don't mind at all. Hang on one sec. It is hotter than, it's hot, it's cold, it's hot, it's cold. Welcome to Charleston. One day it'll be 70 degrees and you're freezing your tail off. And another day it's 59, but it's humid and the sun's out, so you're cooking.
Are you having hormonal problems, George, or what?
Maybe I am, Mike. Maybe I am.
So,
You know me well enough. It could be true. So Steve, let's dig into
I'm going to
that.
go put my red shirt on. Yes, go ahead.
Yeah, I've ruined the color scheme. So let's dig into that. So where do we get? So that was a design, right? So let's design it, and then I wanted to pull some good data to play with the design. Okay, cool. So there are a lot of public sources of data on growth, et cetera. So those public sources, I guess I'm going to keep the black box shut a little bit. I don't want to make it easy for someone who decides they want to build, but there are public sources for that data, and they're good sources, and they're sources that economists rely on. They're sources that you guys know and look at all the time. And the no-brainer is the Census Bureau and NIST, right? They churn out data. So that's where I got that data. Hopefully, we are going to have really, really sharp benchmarking data. I'll make this commitment to you. Eventually, we will have purchased data to put in there. The question is, how interested is the data provider in having their name put out in a rapidly growing business versus who moved my cheese? So do they want to do, you know, that, and that conversation is happening tomorrow. So really good publicly available data from a number of sources. It took me, I love this stuff. So it took me a lot of time to make it all line up. And then I went back and back checked it. I back checked it against the private data source. And again, we're hanging. So we just want it to be as precise as possible. It is already, what I showed you is already precise. Like I can say, manufacturing is growing at this rate, according to, public sources. And the private sources substantiate it. It's not surprising because the data is coming from exactly the same businesses. Just the private source is getting it raw, from the horse's mouth. So
George, can you go back?
Go ahead, Michael.
No, go ahead, Steve. Finish your question. I'm sorry.
I had a flippant comment. I was going to say I'm anal retentive, so I demand you be precise.
Yeah, right.
So George, go back. You said that you were allocating company specific risk.
Mhm.
So what does that mean in terms of and I'm sorry to be so, I don't know. So that's a number, right? So how is that company specific risk? It's a number. How is that number derived? What is it? I mean, just give me a simple.
That I have a white paper written. I teased it, I think, in an article here a few weeks ago. So company specific risk, if I'm being a jerk about it, is I can't say that it's baloney, right? It's opinion based. It's qualitative. And that's the problem. When you do a discounted cash flow calculation of value,
Right, I know.
again, a DCF calculation of value, there's a significant part of that is it's like dark matter in the universe. Like we know it's there, but we don't know what it is.
Right.
Well, the level of opinion, we make some assumptions and then we inject opinion. So you're making assumptions and then you're injecting opinion to come up with a value for a business. Wow, that makes me uncomfortable. And that's there's a Harvard actually law school, a Harvard Law School article about the DCF emperor has no clothes. And it's a really cool article. Good morning, Joe. So
I'm on mute.
if we look at company specific risk, I want to look at it two ways. So let's take a step back. We have the value at a high multiple, and we're highly confident in that number. We have a value at the low multiple that we're very confident in that number. Those numbers are holding together. Literally no one has come back and said of the 500 plus analyses, George, these numbers are kaflooey. Anytime the number is kaflooey, it's because somebody's done something dumb, like like not put in zeros.
Gotcha.
Or not hit submit, the things that happen, but those numbers are sound. Cool.
Right. You have a high and low.
High and low. Now, when we have value, those are based on market data. So when we have a value with strategic capacity, which we're about to introduce into the system, value with strategic capacity is a market-based calculation of value. And we're saying businesses out in the market that look like yours get this kind of value. Very cool. Now, and what if we use, and we're doing this in the lab also, good morning, Ken. We're doing this in the lab, I'm doing it with 3 evaluators also. What if we use strategic capacity to impute the discount rate for a DCF calculation of value? And that works. We just need to check it against actual DCF value. And we are checking it against actual DCF valuations to figure out if we need to have if we need to tweak, if your strategic capacity is 57, to what are we saying 57% of what? Play with that. And do we need to weight that number? Do we need to add add a little? Do we need to take that number up or down? And that's what we're working with to make sure it's accurate. So now you'll be able to say, and very, very, very soon, you'll be able to say, okay, Madam CEO, here is the value of your business at the high multiple. Here's the value at the low multiple. You are somewhere in the middle. By the way, your value capacity is 42. So let's not talk about a third-party sale yet. We can get there. Here's your value at your current strategic capacity. This is how you'd measure up against market. You know, your house is beautiful, but it doesn't have a yard. And if we do a DCF calculation of value, if we just do discounted cash flow, we're going to impute. And you know me, I'm going to put a box in there that says you disagree. You want to put your discount rate in here? Put your discounts. You know, someone like Kent here present, or you, Mike, Steve, you guys are bankers, financial background. You may say, you know what? I think the discount rate here is 20%. Okay, cool. Let's discount it 20%. And then let's talk about what our assumptions are for growth. Well, by benchmarking, we are not going to make assumptions on growth. We're going to make it, we're going to make it market-driven projections of growth. So, hey, we can have and this goes back to what I showed, was it 2 weeks ago? We can talk about you've said you're going to grow at 20%. Here's what that looks like. Historically, you've been growing at 6%. Here's what it looks like. And by the way, the market's growing at 8%. So you're, what are you going, and the real question is, what are you going to change? What are you going to do differently that's going to take you from your historic 6% growth and get you to that robust 20% that you should be able, you should be able to attain? Does that hang together?
Yes, I'm trying to still
draw
draw
spaghetti at the fridge.
I'm still trying to draw a line here. So value at the high, value at the low, and then you have a strategic capacity score. Let's say it's 57%, right? So
Yes.
so now tell me how all those three things boil down to each individual. How do you come up with the dollar value of the improvement in each of the 24 growth drive objectives? How does that translate into this is how much if you improve your strategic your management team, if you work on this, you'll get this much more value for your business. How does that trickle down to that?
Okay, so if we all agree that that a business, let's say that a business that there is company specific risk. That company specific risk results in a discount from top value. Okay, if we agree that that is a reality, and I think that's undisputable, right? That is a reality.
Right.
Well, logically, the company's specific risk can be allocated across the business. It isn't all in one bucket, right?
Gotcha.
It isn't all in the marketing bucket. It's spread across these buckets. And what we're saying is, well, when it comes to what the private capital markets, I don't mean to, when it comes to what the private capital markets look for in a best-in-class business, we have good data on what they look for. And so we're going to give additional weight to the attributes of the business, the growth driving objectives that the private capital markets value the most, or value more than others, not being very, and we're going to give less weight to the ones that the private capital markets wouldn't consider, wouldn't give them pause.
Gotcha.
In the discount. So we're just allocating company specific risk.
I got it. I'm just,
and is that somewhat, is that from our perspective?
Yeah.
But it is a very, you guys know the amount of research that went into this. So it's on a data-driven perspective without me, data-driven perspective.
But so what I heard you say, George, is you're making a judgment on the weighting of the 24 objectives.
Yep.
And then that sets the number.
That's correct. And
that's the
Kent, fire away. Good morning.
I would say it's probably not, I mean, it is probably somewhat subjective, but I would think the majority of it would be objective. Because you can, I mean, in looking at valuation theory, but also in looking at the markets, and and one buyer is going to put more weight to the other. granted, you know, somebody who wants somebody to run the business is going to weight the risk much higher in the management piece than somebody who's looking at buying the business as an add-on. But overall, I think the point and what we need to get to in this conversation is that there is a median or an average way that when you take all of the potential buyers of a business, they're going to weight the risk of the business in a certain way. And based upon that risk and the way that they look at that, they're going to say, okay, yeah, management depth is number one. I'm not saying it's number one. I'm saying it's number one. You know, customer concentration or customer diversification, however you want to call it, is number two. And I think that's, and George, correct me if I'm wrong, but I think that's the way that we get to the individual weights of the specific actions that we can take that will translate into increased value.
That's correct. And what we can't, you know, every buyer is going to have their own bias. If I want to buy your business as a platform, that's one bias. If I'm going to buy your business as an add-on, that is a different bias. If I'm the management team, you know, that is a third bias. And it would be interesting down the road. This is way down the road because we'd have to have our own data set. But when we have, you know, let's imagine having a data set of businesses that have sold, and we have, well, that sure would be cool. Anyway, that's so far down the road that we just not even, but imagine having the data on, you know, what businesses that sold X type of buyer had Y. Now, what we will be able to do pretty quickly, guys, is just say, okay, businesses that are outperforming on margin have these attributes, right? Businesses that are, you know, doing X, and when you imagine having that data, how crazy valuable is that to us all? And then imagine applying AI to our planning or our own intelligence, but, you know, imagine applying that understanding to our plans, because I think we're going to find some surprising things as we look at our own data. And fire away, guys. Thanks, Ken.
Go ahead.
Yeah,
Go ahead,
so,
Michael.
George, you're saying this information is obtained from the private capital markets. What database is that coming from? Is that a PE database? I'm just curious. What's the source of it?
So when we look at the valuations, we're talking about private equity deals, because private equity firms are some of the essentially the only people reporting on an anonymized basis, but reporting this data. Now.
So the other thing that came up when I was going through this as well, the guy that was doing it with me, you know, his strategic capacity score was like 77%. But even though it was 77%, when I showed him the range of business value, his number was stuck in the middle, in that middle box. He wasn't at the upper end.
Yes.
And so it kind of is like, well, wait a minute, I'm almost at 80%, but yet you're sticking me in the middle. You're not showing me. And I guess I think you already addressed that. This is just
and what you're seeing, Michael, is the score is like and this is a blog post I owe you guys. This is a training that I owe you guys. The scoring, think of it as the Richter scale, right? Think of it as decibels. 40 decibels is not twice as loud as 20 decibels. It's exponentially more. A 4 earthquake, we can all stand there and be like, wow, that was cool. A 5 buildings are coming down. So the scoring, if the median business comes in at approximately a 50, what did I say? 53.4. Yeah. So that's what the average, that's the middle of our bell curve. Now, that 85, that's rarefied air. That's getting into the, 19 out of 20 companies can't sell. Well, those 85s are that 5%, right? They're 5%ers. Getting from a 50 in the mid 50s to a 70 is hard. If you go and look at what it takes to get a 70, a C, you know, those are businesses. And if you build out a narrative, and I do it in the book, and we build out a narrative of what a C company looks like, you know, that is exponentially better than mid 50s. It may seem incrementally better, but it's like, listen, a 70 is exponentially better. The jump from a mid 70s to an 85 is also really, really hard, because there are essentially no 85s. There are no 100s. Doesn't exist. There's no perfect company. We all know that, right? There's no perfect athlete. There's no, you know, the perfection doesn't exist. We can come darn close, and that's when we get into the 85s. Was his 77 at a level 1 or a level 2, Mike?
No, this the overall strategic capacities are the clarity one.
Clarity 1.
Yeah.
I believe, and I don't have the data yet, but we will. I just need to sit down and run the analysis. Client meeting, I'll watch later. Okay, awesome. Joe, you have a great day. His 77, I would wager, given 13 plus years of experience in this type of analysis, you know, that his 77 is going to drop. I mean, you can probably just notionally shave 10 or 15 points off of that when you say, okay, show me. You know, when we start digging into, does he have an effective senior leadership team? The way the market would see it, not the way he sees it, the way the market would see it. So his 77 is going to take a haircut. It is very hard to move from, you know, the discounts get handed out very quickly, right? They're gonna take a lop off of the value. And guys, you know, this is your experience, you know. Has this been your experience in your careers? The first whack off of the value of your business is typically not a small one. It's significant, right? And then we start getting into smaller whacks, and that's what we see. That's what we see in the closed transactions, right?
Okay.
So,
So what you're saying to me is that if you're not at if you're not in the 85 to above scoring, right? Then and you're not in that upper right hand corner of the quadrant.
Yeah.
We're putting you in the middle, even though that number in the middle is not that is not necessarily the value of your company.
Mike, well, yeah, and our current graphic representation is about to be improved. So we're about to make that middle. There won't be any yellow block. There will be a yellow marker, and that yellow marker is going to move on the x-axis.
Oh, okay.
Yeah, and the y-axis. It's
All
an
right.
indication. It's an indication of value. The problem is now with the yellow box, people are saying, "Oh, well, I'm worth 4.5 million."
Right.
It's like, well, no, you're just in that. You're in this
Right,
zone
right,
somewhere
right.
between
That was the
4.5
problem.
and 6.
That was the problem I'm having, because the middle of the box, middle box number and the upper value were like almost, you know, they were almost the upper value is twice the middle box value.
Yeah.
And the guy said to me, but wait a minute, I almost scored 80%. So why am I only half of the total value?
So when I roll out value at strategic capacity, and then eventually DCF, but value at strategic capacity, we will also roll out the marker rather than the solid.
Okay, good. That would be better, because people are asking me that, and I
totally
go,
agree.
well, yeah. So one other thing that happened, George, and I think I talked to you about this before I leave. I'm not leaving, but before I finish my line of questioning, is that when we valued his business, he was in the professional service industry, so it was using a multiple of revenues to value, right? It was using a multiple of revenues. But when we went to the equity planner, and we went ahead and projected what he needed to look like in 5 years when he left. When we put that multiple in the box to say, what is your multiple? It was using that multiple as a multiple of EBITDA in the projections, not revenue.
Duly noted. That shouldn't be the case.
And I'm like, yeah, it should be
doing. Let me go and look. Do you mind? Let's talk offline. Let me know what.
Yeah, all right. I'm just telling you, there's
the business. I'm going to go and look at that.
Yeah, there's a little bit of a disconnect there. They're using revenue multiples, and then when you get to the projection software, it's taking that revenue multiple and then it's assuming that it's an EBITDA multiple.
I think there's something going on. because that's not the way it's built. So I want to go and see
Okay.
like what's going on. And, you know, is there a ghost in the machine? It's software, guys. I mean, there's more than one line of code at this point. But Mike, I take that very seriously, and we'll go and look at it. But let's talk about that. I just don't want to share client information in a public setting.
No worries.
Cool.
No
So
worries.
one other point, George, for any business owner that happens to be listening to the recording, valuation ain't a number. It's a range anyway.
It is a range. It is always a range.
That's true.
Yeah. The bottom line is it is what will a willing buyer. That's what we talked earlier about cases, right? If you've now you have a business that's an 85, maybe you do have a platform company, right? You have a business that's really well run and it is sexy.
You know,
I
George,
mean-
I'm sorry. So this guy he had a valuation done by, what's that software? And I can't remember them.
BizEquity.
BizEquity.
Yep.
So he showed me a valuation done by BizEquity, and you know, BizEquity seems to only look at the financial performance of the company
That's correct.
with a value. And I told the guy, look, how about all the intangibles? I mean, you know, there are studies out there that say 80% of your multiple is a function of your intangibles. So
Well, BizEquity, I mean, I don't mean to disparage them, but BizEquity, you know, BizEquity is good for guys who are trying to sell insurance, right? BizEquity is, you know, that's what it's used for. It's good for wealth advisors, but
right,
it's useless to people like us
right.
because it doesn't consider strategic capacity at all. It
Right.
doesn't say what, you know, is the business dependent on you at all? That question
Right,
is never
right,
asked.
exactly. It kind
Right?
of, and I told him, you don't think you're going to get that if you went to market, do you? And he goes,
Yeah.
well, this valuation says I'm worth X number of dollars. I said, yeah, but
Yeah.
you know, but
No. And
but, you know,
when
but
you
it-
get behind the scenes and you figure out, Mike, as I
Right.
may have done, how they calculate value, they're making some profound assumptions, and then they're fudging. I have a report right here, and then they're fudging the number. Like, you could be worth this, you could be worth that, but you also have liquidation value. Which these are all correct. It's not BizEquity is good at what it does, but for guys like, you know what it also does? Mike, the implied point you just made, which I'm in violent agreement with, is now what? I need the business to be worth 10. You're worth 6. That's it. And they're like, okay, have a nice day. It's a value monitor. It's like that commercial. Like, no, hey, listen, I'm not actually a dentist. I can just tell you I'm a dental monitor. BizEquity is a value monitor. It doesn't, your value isn't actionable in any way, shape, or form. So,
but this person, this company that I'm starting to work with is using that as the basis for partner buyouts. And I'm like, you're crazy. What are you doing?
I was about to say, does anyone else have hives right now? Yeah.
Yeah, I go, you're crazy. I mean, you know, we just talked about the fact that your business is, you know, you don't have, you know, well, they have a lot of issues, right? I'm not going to spill the beans, but they have a lot of issues around management team, succession planning, customer concentration, all this stuff, right? I mean, and now, you know, now they're using this valuation by BizEquity, and they're going to say, well, we have a valuation, so we're thinking that that's what the price is going to be. And I go, well, you know, first of all, you know, if you're going to buy somebody out, it's a minority interest, so you're not even discounting for minority interest. So that's right off the bat, that's wrong. But anyway, I'm just throwing that out because, you know, anyway, I don't want to keep droning on, but
No, you're not, it's BizEquity is a fine tool. But it is a tool of very, very limited relevance and impact. And for guys like us, it is a tool that actually causes more confusion.
It does.
I mean, I'd rather use Clarity without a calculator. Like, let's just erase the value and let's talk about the business.
Right.
Let's talk about strategic capacity.
Right.
Let's talk about your strategic intent, right? What is your intent and what's your capacity to get there? Then we can devise a strategy.
It potentially get your client oriented in a direction that is a constraint for you as an advisor. And you've got to recenter them before, so you got to actually take the time to recenter them in really valuation and really market valuation. and what's true market valuation before you can actually do your work. That's to me, that would be the frustrating part.
Yeah.
I
I have a question, George.
You already got it. Yeah.
So in one of my trusted advisors group, I have the head of Murphy Business Sales. He looks over all of North Carolina. Very sharp guy, you know, he's an Air Force pilot. But anyhow, he is really good. And so Murphy Business Sales, and I'm trying to figure out, would it be a value add or not? He'll do it for $3,500. That's kind of what their thing is. They'll do a full evaluation, which is cheap. It's cheap.
It's cost effective.
And that they don't audit your books. They're gonna say, hey, you know, you give me your numbers, but I mean, but they do go into all the NAICS. I mean, they go dig down into that. It's all based on your numbers. So if your numbers are bad, then their numbers are bad. But other than that, they do a full evaluation because he did a presentation for my CEO peer group. And they're like, this is, and you can tell the guy knows his stuff. He's been doing it for like 14 years. Do you think that would be a value add or not to say, okay, George, let's take a look at your business. And if you want, we can also bring in, you know, Ron to do it for you. You know, because it's going to be more, because his business is 81% of his business is sell.
Yeah.
You know, so
Hey,
I mean,
Bob,
he's the real
this-
deal. And so I'm trying to figure out, would that be a value add or not?
From your description, Ron, it sounds like he's not doing anything other than BizEquity quality evaluation.
He would almost, the number of assumptions, it goes back to the part of the conversation. Is it a value add? It's a value add to him, for sure. And not that there's nothing wrong with that. It's certainly a value add to him. But is it potentially confusing to the CEOs?
That is precisely my question.
That is, and the challenge here is, and you know, let's have a quick show of hands. Who believes that if we think of Bob's group and we have 10 guys and gals sitting around the table, who believes that any one, let's take 10%, any one of their books would be up to due diligence standards? I'm not putting my hand up for that. You know, that you hit it right on the head. Their books, they will have been running. My guess would be, and guys, back me up if you know, agree, disagree. Their books will have been, their books are done to mitigate tax liability, right? And we all do it. We all want to pay the minimum amount required by law, right? We want to comply with the law, but we don't want to pay any more than we have to. And we're going to do things, you know, in how we allocate profit. I mean, you take a business, you know, most industries are, you know, we use some measure of profit to calculate the value of the business. If you've been minimizing your profit, the first thing we need to do is right size your numbers. So when Murphy Business Sales, that accounts for a lot of sales in this country, right? When they're one of the big guys, as a system, if he comes in and says, okay, well, give me your 3 last tax returns, give me your projections for this year. We're probably undervaluing the business. I'm just making vast generalizations. My concern, Bob, would be, is that you're going to create confusion in your CEO group.
Okay.
Yeah.
Guys, any thoughts, comments?
Yeah, well, the issue is there's so many different factors. You know, I would really want to understand how they go through the process of evaluation. Number one. Well, let me just say this. Number one, I wouldn't let him do it, not to any of my clients. Just because he's a business broker and I understand where his intention is, regardless of what he says. He's looking to sell businesses. And the first thing I would do is say, okay, well, 81% of the businesses sell that you take on. And I would have 2 questions for him. Number one, you must be really, really selective about who you take on because in the market, only about 10% do. And number 2, are you selling them on the left side of the bell curve? Or in other words, are you selling them for less value than they should be bringing? at 81%, those would be my big two questions. But from a standpoint of just bringing somebody in to do evaluation, unless you really understand, are they, what type of, number one, I wouldn't do it for anybody because even getting a CPA firm or evaluation firm to do it, I wouldn't do it. And the reason is because because of different types of valuation. You have different types of valuation, you have different types of valuation. What I want to know when I'm sitting in front of a CEO and I'm having a conversation with the CEO is, if you've got a 3-year time horizon or you have a 5-year time horizon, how much are we going to put in your pocket at the end of the day? Because that's what's important. And so if you look at it from that standpoint, then you look and you say, what's the probability that we're going to sell to one type of buyer or another? Because that's going to also drive what you do within the execution piece that's coming out of Growth Drive. So in other words, if we're going to be an add-on to some publicly traded company, that's one way that we want to position the business. If we want to position our company as a platform, that's a different way. If we want to position our company as an IPO, that's a different way. So as an advisor, you got to begin with the end in mind. Sorry for talking too much, but you got to begin with the end in mind, and you've got to prepare and set the course based upon that target that ultimately the CEO or the owners of the business want. So if I'm bringing in somebody from the outside and they don't understand that, and they don't understand, hey, this is what I'm doing, and they're just throwing a valuation, they have a very high likelihood or high probability of taking my client out of focus for where I'm trying to get them.
Yeah.
Okay. Well, I appreciate
the
that.
other-
Get your thought on that.
The other thing I would add, just in case anyway, all he's doing is doing a numbers calculation. I do that every day too, but it doesn't take into account any of the things that we just talked about for the first half hour of this discussion, the qualitative characteristics of the business, or some of the other things that Kent mentioned, and who's the buyer going to be, and blah, blah, blah.
Okay. Thank you, gentlemen.
Sure, man.
Can I change the topic?
It's a conversation, dude. Feel free.
Okay. So I don't know if you've got data on this or not, but for someone like Michael was just talking about, and the guy I've recently talked to, that rates really, really high. And there may be some bias in your data, but how often, when you do the senior leadership assessment and everyone rates the company independently, do the numbers end up being what the CEO said, I'm an 80x%?
I have to go back and run an analysis. So let me give you, I'll give you an anecdotal, not anecdotal, I'll give you my best guess. So there's never alignment. And generally, there's CEO optimism. And who did I just do one for? I just did one for Barry. And this was absolutely reflective. I just did one for Bob. When there's typically the CEO's like, yeah, no, my sales team's nailing their numbers, everything's great. Where, they tend to be optimistic. They're not stupid. They don't peg everything at the top, but they generally peg things higher than the senior leadership team. And so, Steve, I want to make sure I understood your question correctly. Can you restate it, please?
Well, I'll use my specific example. I had a guy that did the Clarity one, and he came out with a rating of like 82% or something like that.
Yeah.
So it's unwritten, and that's the guy I asked you about, and you said that's about at the 2% range.
Yeah.
So I'm wondering if I somehow got him to do the senior leadership thing, if his eyes would get opened, i.e. the 82 would actually, if you look at everyone doing the rating, is now 72 or 60.
You're going to bring
whatever.
You'll bring it. And most people, again, and typically not that the senior leadership team, there's lack of alignment amongst the senior leadership team. It's not like the CEO is saying we're top of the world and everyone else is saying we're the worst. You know, there tends to be a distribution amongst the team. And even on surprising things, we just did an analysis where the senior leadership team, even the CEO did not put down a different number for their gross annual revenues. And then one of the answers, and I don't know who these people are, but we're looking at the answers, and one of them put it down to the dollar. I'm like, well, I'm guessing that's the CFO. And it was, in fact, she had given the exact number, and people were off, not by $100,000. She had put in, let's say, 7.5 million, and you had a couple of people saying 11. Well, like, how could this be? Right? Talk about misalignment. But you'll typically see, Steve, that the CEO tends to be optimistic. So let's say the CEO comes in and says, "Yeah, we're a 70." Your team is going to come in somewhere in the mid 50s. Now the typical and that alignment report, once we pass the alignment report across the desk, we're saying, okay, well, here's where you think you are on the map. Here's where your senior team thinks they are on the map. And do you think that's worth a conversation? Then this goes down to qualifying your client. You're going to figure out very quickly if, first off, they tell you that you can't do the senior leadership alignment. That's a qualifier in my book. Okay, I'd be in the back of my mind saying, well, then you're not ready to execute a plan. You may get there, but right now, today, you're not ready to execute a plan. Let's keep talking. And I would probably stay in sort of a project mode. What can we do together? Because in the best scenario, and this isn't the question you asked, but in the best scenario, we're going to do a senior leadership alignment report. And the CEO is willing to be transparent, is willing to listen and to share, and maybe to right size other people's understandings. And maybe to have their understandings right sized, right? To use a term. But then if we have that, and now what we've done though is we've now educated the senior team about the 3 dimensions of growth and strategic capacity. And if we then imagine the difference between having a deep analysis, especially on dimensions 1 and 2, cash and growth, that is just from the CEO's perspective and building a plan based on that, or having run a facilitated session where we analyze strategic capacity with the team, again, especially around dimensions 1 and 2. Because everybody's opinion as to whether the numbers can be audited or not, or whether or not we have our governance docs in order. That's why I leave dimension 3 kind of to the side. You can do it, but dimensions 1 or 2 at this point are critically important. Now we're going to have a plan based on consensus. We also have a plan in which people have emotional buy-in. I was heard. I made my perspective clear. And now we're creating a plan that is a team-based plan. And I would argue that, getting that alignment up front and then making sure there's alignment around the analysis that we're using to create strategy is also important. So I just answered a question you didn't ask, but does that make sense? Any questions?
So George, in other words, the strategic, the senior leadership alignment process. Yes, we need the report. We need to know where people are, but the outcome, the goal is to eventually get everyone together so that they all walk away with the same point. It's the same point of view, but they agree that this is where we are, and they understand. Everyone walks away with a similar, aligned view as to where the company is and where it needs to go. Right.
That's right. It's the goal. And like most negotiations, let's say we facilitate. So, for anybody watching this, imagine do we have an effective senior leadership team? And somebody says, yeah, we have a great senior leadership team and the business runs smoothly when I'm not there, CEO. And then you have the senior leadership team saying, we don't have the authority we don't make any decisions. It doesn't run smoothly. We just kind of do our jobs while you're gone. Okay. Let's have that conversation. If we do that across the business, what we have is we can think of it's sort of color of a negotiated consensus. Not everyone is going to be happy with the final product, but everyone will have had a say, and everybody, you know, will have been heard. And so it's not a negotiation, but it has the same. It's the same. Not every, you know, I think no one is thrilled, but everyone's satisfied. Does that make sense?
Yep.
Yeah. I mean, like most facilitated sessions, and well, like most facilitated sessions that hang together. Kent, looks like you have a thought there.
No, I'm good.
Okay. I'm out.
Hey, so George, so I'm working with an architectural firm that I'm working with another advisor on it, and he started the process, but he's using Value Builder
Okay.
with them. So he has already had those folks take the Value Builder assessment on the business.
Yeah.
And I don't want to, and so, and I could tell you that it's all the 7 partners and the scores are all over the place. I mean, some people are up here, some people are down here. It depends on how long they've been a partner and their ages and all that. But I guess with that information, you could still build a strategic alignment report and facilitate an alignment workshop, even though it's not around the 3 dimensions of growth, right?
You could. It's not as granular, you know.
Right.
John Warlow's.
Right.
It's a very. It has 2 characteristics. One, it is not very granular.
Right.
And 2, it is very, very good at the Main Street level.
Right.
It becomes less relevant as the business grows.
But I can see the things they're asking about they're very similar to what we ask about as well, but
Yep.
they only measure like 8 different things or 9
8
different
things.
things.
Yep.
8 things.
8 things. Yeah.
And I was looking at some of the scores, and the as you pointed out, the guy who runs the firm, his is up here, and then the new people coming in, they're down here, and it's all over the place. So it's going to be, but I guess from that information, you can put together a report showing there's not alignment, and then try to get people, because I told them, if we don't have everyone in alignment here, then it's not worth our time to do anything, because you'll have 7 different people rowing in 7 different directions, and you won't get anything done.
That's right. And a question, one of the questions, and I'm sure, I'll state the obvious, is if you have people who are new to the business, is it a lack of understanding?
Yeah,
Or is it
probably
a very clear understanding coming from the outside world saying, wow, you guys think that you have you have
No, I think the younger folks don't really have visibility to a lot of this information, and therefore they don't know. But
What was it? Was it a leadership team who took that
partners,
partners?
yeah.
How many? How
7.
many?
7. And they range. There's 3 of them. They're in their 60s. 3 of them are in their 50s. There's more than 7. There's like 8 or 9. Sorry, 3 and 6. Go ahead.
And they basically took the Value Builder assessment. Is that what you're?
Yes.
Yeah.
Yes.
Yeah. I mean, my response to that would be, okay, guys, my biggest concern is we're all over the map.
Right.
And so we need to actually do some work before we even think about
Correct.
evaluation.
Correct.
So that's where I would go. I would have a couple hour session, and let's really hit that in the head and see if we can't get the when a plotted graph, get them more concise.
Correct. I got you.
Yeah, and then before you'd move forward.
So, but at this point, I don't think it makes sense for them to take, the growth drive, to use the 24 questions, to have them take that now, in addition to what they just did. Well, some of them haven't finished it yet. We only got like half of them. I'm just wondering, since I've been being brought in now, maybe I can tell the guy who runs who's the guy, the contact, the guy who's their CPA, and I can tell him, look, I know you did this, and that's great, but I'd like to use this tool. Have them answer these 24 questions instead, and then start the process over again using this methodology. Because I think it's better than the Value Builder one, which is very superficial.
I can only tell you what, based on the limited information that you've given me, here's where I would come from, Michael, is I would say, look, we've got more issues in this leadership team than valuation. And unless there's something that's really driving it. And we need to work on the business before we can attempt to get a reasonable valuation within a reasonable range based upon the information that you've already shown me. So I would actually work with them for 6 months, 3 to 6 months. I'd say, look, we're going to work together 3 to 6 months. And then we're going to take another assessment. It's going to be different, but don't worry about it. It's in other words, I would downplay the fact that you're going to switch them over, but it's a better assessment. It's something I use, and you can give them all the good points as to why you're going to use that assessment. But that's the way I would position it. Say, look, guys, we got work to do before we can even talk about valuation.
So
And I would try to get them into some type of rhythm as far as a leadership team meeting, allowing you to come in and facilitate some of the conversations that will help get them together. And that's what I would do. And I know, I'm a little bit different, but that's what I would do.
So would you disregard the value builder reports that
I
they
would.
put out?
I would. I mean, you can read it and you can understand where the big gaps may be.
Right.
That would be good information. So that you could potentially prioritize what you want those sessions to focus on.
Right.
So and then just say and lay them out, a 90-day or 180-day. Hey, we're going to run through these sessions. We're going to have them once a week, once every other week. The first thing we're going to talk about is there seems to be a big gap in understanding this about the business. So, so basically we're going to, from a factual standpoint, facts are easy. You bring them to the table. But then from a standpoint of direction, vision, values, that's where you're going to get into the initial conversations about what do we want this company to be and where are we now? So
that was the key. What do we want this company to be? And that is going to be that's strategic intent, right? That's the ultimate.
Yeah.
Mike.
Okay.
Mike, I don't know your exact situation, so I can't give you a precise answer, but I would dissent from Kent. If it's easy for you to slip in the growth drive, I would do that sooner rather than later. Like I would do that next if it was politically palatable for.
Yeah, I think it is. I mean, half of them haven't even filled out the thing yet, so it's a good time to say, look, I have a better tool. I think after my initial kickoff meeting with you all, I realized there's a lot of issues here that require deeper analysis, and the tool I'm going to have you use and the questionnaire, I think, is going to provide us with more information on what's going on than the one that we were going to originally send out to you. So I think based on my, again, our initial kickoff meeting, I think this tool is more robust, and I think it's going to best serve us all.
And one of the arguments, if you go in that direction, Mike, one of the arguments is, listen, it's more granular,
right?
But it's very approachable, and it has additional depth to it, which Valuable doesn't have. We have a much deeper.
And it's just a matter of, George, it's just a matter of them answering those 24 questions, right? Or did they go through the whole Clarity one?
No, they can just answer. You can use lead generator with
the lead gen tool.
Lead generator with the non.
Right. So this is going to make it easier for them, because I think going through that value builder thing takes them time, and maybe this is a faster way of getting the results. It's just 24 questions.
This they do this while they're having half a coffee, so no big deal.
So I'm making it easier for them to complete, and I think it's a more robust tool. So I'm going to go that. I'm going to try to approach it that way, because then I can move them into the growth drive system.
I want to underscore something that Ken said. It's what's your intent? Where are we going here? And And that whether it's only the owner, I mean, at a minimum, we need to have the owner say, well, this is where this is how this plays out.
Okay, I got it, guys. Unfortunately, I have to run, but this is
Yeah,
always,
so I think
these
we
sessions
all-
have always been unbelievably valuable to me, and I appreciate it.
Yeah,
Michael,
I do.
thank you.
I do as well. Guys, good to see
Bye,
you.
guys.
And listen,
Yeah.
everyone, this was a great conversation. Thank you. And
Thank you.
see you around campus.
Yep.
All right, man. Thanks,
Thanks,
guys.
Lemon.
Bye-bye.
Bye.
Bye.